Welcome to the journey through the mind of Warren Buffett, one of the wealthiest and most successful investors in history. Known as the Oracle of Omaha, Buffett's approach to investing has turned a failing textile mill into the powerhouse known today as Berkshire Hathaway, a conglomerate with a staggering market capitalization. But how did a young boy from Nebraska, who bought his first stock at age 11, grow to amass billions? The secret lies in his simple yet profound investment rules that have stood the test of time. In this video, we'll uncover the 10 golden rules that can guide even the most novice investor towards financial wisdom and success. Did you know that Warren Buffett's initial investment of $114 in 1942 would be worth over $600,000 today if invested in the S&P 500? Yet, Buffett's own investments have far outstripped this, showcasing his unique ability to pick stocks that beat the market consistently over decades. Stay tuned as we break down each rule with real-life examples, starting from investing in what you know, to understanding the economic moat, all the way to the importance of continuous learning. Whether you're just starting out or looking to improve your investment portfolio, these insights from Buffett himself promise to offer invaluable lessons in wealth building. Prepare to be inspired by the simplicity and effectiveness of Buffett's strategies that could potentially change your approach to investing forever. Introduction to Warren Buffett's investment philosophy. Warren Buffett, the Oracle of Omaha, is not just a name, he's a phenomenon in the investment world. Known for his humble lifestyle and immense wealth, Buffett's investment philosophy can be boiled down to simplicity and patience. He believes in investing in companies that are not just businesses, but are also something he understands thoroughly. Buffett's approach revolves around choosing companies with predictable and proven earnings models. He focuses on businesses that exhibit long-term value, and he's famously quoted for saying, "If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes." This highlights his commitment to long-term investment strategies over short-term gains. Interestingly, Warren Buffett started investing at a young age of 11, and yet he regrets not starting earlier. His early start and persistent approach have been crucial in capitalizing on the power of compounding, one of the cornerstones of his success. As of now, Buffett's Berkshire Hathaway consistently outperforms the market, showcasing the effectiveness of his investment principles. Rule 1. Invest in what you know. The first of Buffett's rules is to invest in what you know. This principle seems straightforward but holds profound implications. Buffett urges investors to venture only into markets and companies they understand deeply. This minimizes risks associated with unknown factors and market volatility. For instance, despite the tech boom, Buffett long refrained from investing in technology companies because he did not feel he had a firm grasp of the industry. Investing in familiar territories allows you to make educated decisions based on a profound understanding of business models, market conditions, and potential growth. Take Coca-Cola, for example. Buffett invested in Coca-Cola because he saw it as a simple business whose product had a wide appeal and would stand the test of time. His investment in Coca-Cola has been massively profitable, illustrating how well this principle has worked for him. Warren Buffett's strategy is also about avoiding the noise of the market. He famously skips the daily market trends and focuses on the underlying qualities of the business. This method ensures that his investment decisions are based on business performance and fundamentals rather than speculative trends, which often lead to erratic market behaviors. Rule 2. The economic moat concept. One of the core components of Warren Buffett's investment strategy is the concept of an economic moat. The term, borrowed from medieval castles, refers to the ability of a business to maintain competitive advantages over its competitors in order to protect its long-term profits and market share. Buffett believes that investing in companies with a strong economic moat is crucial for sustained financial success. So, what makes a strong economic moat? It could be a brand reputation, proprietary technology, regulatory licenses, or large scale that competitors simply cannot match. Take Apple Inc., a prime example of a company with multiple moats. It boasts a strong brand identity, a loyal customer base, and an ecosystem of products that work seamlessly together, factors that competitors struggle to replicate. Buffett's focus on economic moats is evident in his long-term holdings. He invests in companies like Geico and Duracell, which possess unique strengths that protect them from competition. These companies not only have strong brand names but also cost advantages or unique products that keep them at the forefront of their respective industries. Rule 3. Value versus price. Warren Buffett's distinction between value and price is fundamental to his investment approach. He famously stated, "Price is what you pay, value is what you get." This underscores the importance of not confusing a company's stock price with its true worth. A low price doesn't necessarily mean a good buy. Similarly, a high price doesn't inherently make a stock a bad investment. Buffett advocates for focusing on the intrinsic value of a business, which involves understanding its real, tangible and intangible assets, and future cash flows. This approach requires a deep analysis, often looking at the earnings reports, management quality, financial health, and market position of the company. For example, during the 2008 financial crisis, when most investors were selling off their stocks at low prices, Buffett was buying. He invested $5 billion in Goldman Sachs, not because the stock price was merely low, but because he believed the intrinsic value of the company was much higher. This move was quintessentially Buffett, ignoring the market noise and focusing on the company's fundamental value. Rule 4. The margin of safety. The concept of a margin of safety is fundamental in Warren Buffett's investment strategy. This principle involves buying securities at a significant discount to their intrinsic value, thus providing a safety net against errors in estimation or unforeseen market downturns. The margin of safety helps protect investors from significant losses and improves the prospects for favorable returns. Buffett often emphasizes that the margin of safety is not just a protective measure but a philosophy of ensuring that investments have room to falter without devastating consequences. For example, Buffett's purchase of Washington Post shares in the early 1970s was based on his calculation that the company was significantly undervalued. This investment not only provided a substantial safety margin but also resulted in a multi-billion-dollar payoff as the company's true value was gradually realized by the market. The key takeaway from Buffett's approach is to be conservative in valuation and to seek a buffer that can absorb miscalculations or market fluctuations. This requires disciplined analysis and patience to wait for opportunities where this margin is sufficiently wide to ensure minimized risk. Rule 5. Be greedy when others are fearful. Be fearful when others are greedy, and greedy when others are fearful, is one of Warren Buffett's most famous adages. It captures his counterintuitive strategy to buy stocks during market downturns when panic selling often leads to significant undervaluation of solid companies. By going against the crowd, Buffett capitalizes on market overreactions to secure valuable assets at low prices. This principle was vividly demonstrated during the 2008 financial crisis, as mentioned earlier. While the financial world was in turmoil, Buffett saw an opportunity to invest in trusted companies at bargain prices. His investments, like those in Goldman Sachs and Bank of America, were made at a time when most investors were fleeing the stock market. These decisions required not only a deep understanding of the market's intrinsic value but also the courage to act contrary to popular sentiment. Buffett's ability to detach emotion from investing allows him to make decisions based purely on rational assessments of value versus price. This stoic approach ensures that he makes purchases not based on market enthusiasm but on hard, financial metrics and long-term potential. Rule 6. Long-term perspective. Warren Buffett is renowned for his long-term investment strategy. He views his investments as though he is buying a piece of a business, not just a stock. This mindset shifts the focus from short-term fluctuations to long-term potential and sustainability. Buffett's approach is about understanding and believing in the business's future prospects and standing by it through market cycles. For example, Buffett's commitment to companies like Coca-Cola and American Express, held for decades, illustrates his belief in holding quality businesses over time. He chooses companies that not only have strong present standings but also the potential for enduring success. This long-term perspective allows him to benefit from the power of compounding, one of the most critical elements in building wealth. Rule 7. Quality over quantity. Warren Buffett's investment portfolio is not about having a vast number of stocks. Rather, it's about focusing on a few high-quality businesses. He believes that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This rule stresses the importance of investing in companies which are leaders in their industries, have excellent management teams, and possess solid financial foundations. Buffett's focus on quality over quantity can be seen in his approach to purchasing Apple stock, which became one of the largest holdings in Berkshire Hathaway's portfolio. Apple's strong brand loyalty, innovative product line, and robust financial health align perfectly with Buffett's criteria for quality. By investing in such a company, he ensures that his investments are secure and likely to yield high returns without needing to manage a large portfolio of average stocks. Rule 8. Avoid debt. Warren Buffett is cautious about debt. He advises investors to steer clear of companies burdened with high levels of debt because it can limit their growth opportunities and pose significant risks during economic downturns. Buffett believes that debt is akin to a double-edged sword. It can enhance gains but also magnify losses. A prime example of Buffett's aversion to debt is visible in his own company, Berkshire Hathaway, which maintains a large cash reserve and minimal debt. This conservative financial structure provides a substantial buffer against financial crises, allowing the company to act opportunistically when less stable firms may be forced to sell assets or equity cheaply during market stress. Rule 9. Reinvest profits, and Rule 10. Learn continuously. Combining two crucial principles for the final chapter, we explore Buffett's advocacy for reinvesting profits and the relentless pursuit of knowledge. Reinvesting profits is a strategy that Buffett has employed time and again, choosing to plow back earnings into the business rather than distributing them. This reinvestment fuels future growth and leverages the power of compounding. Continuous learning, on the other hand, is integral to adapting and staying relevant in the ever-changing market landscape. Buffett spends a significant part of his day reading, from financial statements to multiple newspapers and books. This habit ensures that he remains knowledgeable about market trends, economic conditions, and technological advancements, all of which inform his investment decisions. An illustrative example is Buffett's recent shift in strategy towards technology investments, such as in Apple and Amazon, which indicates his ability to learn and adapt to new market realities. Despite his earlier reservations about investing in technology companies due to their unpredictable nature, his continuous learning enabled him to understand and appreciate the value these companies could bring to his portfolio.